Have you ever noticed how banks are like litter boxes? Everything seems fine until one day it all goes to crap. My human recently spilled iced coffee all over her laptop while reading news about a bank collapse. Total panic. I, of course, was perched calmly on the fridge judging from above. But it got me thinking what actually causes banks to fail. Welcome to Bank Failures Explained by Cat. Curl up, my friend. This is going to get delightfully chaotic. Alright, picture this. You give your money to a bank. Maybe it's your paycheck, your savings, or that $50 grandma gave you for your birthday, even though she called you your cousin's name. Whatever, you trust the bank to keep it safe. But here's the catnip twist. Banks do not keep your money locked in a tiny treasure chest waiting for you. Nope, they lend most of it out. Mortgages, car loans, business loans. Your money is out there in the economy living its best life. Banks keep just enough cash on hand in case you or a few other people come by and want some back. The rest out the door faster than me when someone turns on the vacuum. This system works because of trust. You trust the bank. The bank trusts you will not ask for all your money back at the same time. But what happens when that trust evaporates faster than a puddle in Arizona boom bank run? Imagine a rumor starts. The bank might be in trouble. People panic. They all rush to withdraw their money. But remember, the bank doesn't have it all sitting there. It's out earning interest somewhere. The bank can't meet everyone's request at once, and so it collapses. Not because it was immediately insolvent, but because everyone believed it was. It's basically a financial stampede. It's like if one cat sprints out of a room and suddenly all the cats freak out and run too, even though no one knows why. Maybe it was a cucumber. Maybe it was nothing. Doesn't matter. Now the room's empty and everyone's hiding in the laundry basket. This is exactly what happened with Silicon Valley Bank in 2023. It catered heavily to tech startups, held a lot of long-term treasury bonds, and when interest rates rose quickly, the market value of those bonds dropped. Suddenly, their balance sheet looked shaky. Add some worried group chats and a few tweets from influential investors and bam. Modern-day bank run over $40 billion withdrawn in one day. To prevent this madness, we have something called the FDIC, the Federal Deposit Insurance Corporation. It insures deposits up to a certain limit, currently $250,000 per depositor per bank. So even if your bank goes belly up, you're not totally doomed. It's like insurance for your food bowl. If my kibble stash disappears, the FDIC is basically the human who brings me more. But here's the kicker, not all deposits are insured. Big companies with millions stashed in one bank, they're above that limit. So when they hear the bank might be in trouble, they don't wait, they run. And when the big fish swim fast, the little minnows start panicking too. Now let's zoom out. Why do banks take such risks in the first place? Part of it is how banks make money. They lend at higher interest rates than they pay you. That difference, called the net interest margin, is their profit. But to boost returns, banks might invest in riskier stuff, like long-term bonds, subprime mortgages, or whatever was in that mystery folder labeled totally not a scam. And if the economy shifts, say interest rates spike, or real estate tanks, those risky bets turn sour. Suddenly, the bank's assets, loans, and investments are worth less, while their liabilities, your deposits, stay the same. That's how they end up underwater. Not in a spa day relaxing bath way, in a Titanic no life jacket way. Also, banks are interconnected. One collapse shakes the whole system. Remember 2008, the Great Recession. It started with subprime mortgage defaults, took down Lehman Brothers, and sent shockwaves through the global financial system. Credit froze. Businesses couldn't get loans. People lost jobs, homes hope, even their Netflix password. Why do governments step in during bank failures? Because panic spreads fast, and economies run on confidence. If people think banks are unsafe, they hoard cash under mattresses, stop spending, and everything slows down. It's like yanking the yarn out of a well-knit sweater. The whole thing unravels. To stop this, the government might backstop deposits beyond the insured limit, like it did with SVB, provide emergency loans to banks, merge failing banks with stronger ones, or straight up take over. But all of this costs money, which usually comes from taxpayers, or in some cases, future inflation. Think about it when the government steps in to bail out a collapsing bank, it's not pulling dollar bills out of thin air. Well, sometimes it is, but then that thin air gets thicker with inflation. And who feels that every day, folks? Suddenly, your human's oat milk latte costs 50 cents more, their rent jumps, and you get downgraded from gourmet salmon pate to that bland chicken mush you only eat under protest. Inflation is like when someone keeps adding litter to the box but never scoops anything out. Sure, it's technically full, but it stinks. Long-term repeated bailouts without accountability can stretch government budgets, fuel inequality, and erode public trust in the system. So while the rescue might calm the immediate crisis, it leaves claw marks on the couch of the economy for years to come. So yeah, the mess spills onto your rug and mine. Let's not forget moral hazard. Back in 2008, we saw this play out in real time. Big banks loaded up on toxic mortgage-backed securities, made reckless bets, and when the house of cards tumbled, they cried for help. Some were allowed to fail, looking at you Lehman Brothers, but others got massive massive bailouts. No jail time, no major consequences, just golden parachutes and taxpayer-funded rescues. Imagine if I knocked your favorite vase off the shelf, shredded your curtains, and then got rewarded with a can of tuna and a belly rub. What lesson do I learn that I'm too fluffy to fail? That's moral hazard. When institutions believe they'll be saved no matter what, they take risks they otherwise wouldn't. It's not just bad finance, it's bad behavior. And unless we hold these players accountable, the cycle repeats, just like me knocking that same vase off tomorrow. If banks know they'll get bailed out, they might take bigger risks. It's like letting your dog drive the car because you know insurance will cover it. The entire financial system depends on finding a balance between freedom and regulation, innovation and safety. Some argue we need stricter rules, higher capital requirements, more oversight limits on risky assets. Others say too much regulation stifles growth and makes banks too cautious. But then again, no one likes a cautious cat when there's a laser pointer involved. Also, let's talk tech. Mobile banking means withdrawals happen at lightning speed. In the past, a bank run meant long lines outside buildings. Now it's just a few taps on a smartphone. Bank failures can go viral faster than a cat in a shark costume on a Roomba. This new digital landscape means panic doesn't build, it explodes. Banks need better tools to manage real-time liquidity and communication strategies to address concerns before they spiral. Regulators are also struggling to keep up. Many of the rules were written in a time when the scariest tech around was a fax machine. Now we have AI trading bots, decentralized finance apps, and banking decisions made in group chats. It's like trying to catch a laser pointer with oven mitts. Then there's social media. One tweet from a big investor, boom, confidence cratered. The bank's future becomes a meme, and not the fun kind. More like the "this is fine" dog surrounded by fire. So what do we learn from all this? 1. Trust is everything. Without it, banks fail. 2. Diversification is key. Do not keep all your kibble in one bowl or all your money in one bank. 3. Regulation matters. We need smart rules to prevent reckless behavior, but not so many that the whole system suffocates. And 4. Next time you hear news about a bank failing, don't panic. Ask questions. Look at facts. Maybe consult a financial advisor, or at least a cat with decent internet access. While it's tempting to join the digital stampede, rash decisions often cause more damage than calm, measured ones. Financial systems like cats respond better to slow blinks than frantic tail flicks. Ask questions, look at facts, and maybe move some money, but don't spark a stampede. Because at the end of the day, banks are like cardboard boxes. Useful, cozy, but sometimes they collapse when you jump in too fast. So sit back, sharpen your claws, and remember, even in finance, curiosity didn't kill the cat. Panic did. And maybe, just maybe, that one guy on the group chat who says, "Bro, I heard from a friend of a friend, we should pull everything out now." Yeah, that guy might be more dangerous than inflation. The truth is, bank failures are like when the vacuum turns on unexpectedly terrifying loud, and no one really knows where to run first. But if we stay calm, ask questions, and maybe double-check that our financial litter boxes are clean and diversified, we'll be just fine. Probably. Unless your bank just got acquired by a startup called Crypto Catcoin Trust Inc. In that case, best start hoarding cans of tuna. The end. Unless, of course, your bank app just crashed. In that case, good luck.